Archie.
Okay, you've all been waiting for it, so here it is. It's the Bitcoin Quantile Model by the real Plan C. Plan C, welcome, man.
Yeah, thanks for having me. Looking forward to the conversation, and I love your content, and looking forward to getting into. There's a lot going on as always, and I think a lot of people are interested right now, especially after that kind of crazy liquidation cascading crash we had recently. So I think most people are interested in kind of where we sit, and this cycle is unique, so at least a lot of indications it might be. So looking forward to chatting.
Yeah, it does look that way. I guess a $19 billion liquidation in the entire crypto ecosystem gets some people panicking, but really it's been pretty mild, to be honest. Like the panic in the room, I wouldn't call it like an excessive situation right now. It's more a matter of curiosity. I say that because I'm all in Bitcoin, but I'm sure there are people watching out there who've lost a lot of money on what some people call alts, but probably more accurately described as shitcoins. So I guess there's a lesson in that for everybody. But how did you see what happened last Friday?
Yeah, it's interesting. So I did not register initially how big of an event it was because, like yourself, I'm basically I'm only holding Bitcoin. I'm only holding Bitcoin and I have no leverage. So because of that, I wasn't in any kind of a panic. I actually didn't, because I'm also not. I'm just checking the prices on, CoinMarketCap or whatever. If you're on a specific exchange at the time, there was quite a differential there's a big delta between a lot of the exchanges. So depending on what exchange someone was on, that panic could easily have been amplified, right? So if you're trading or if you're just looking at a specific exchange and you're on one of the ones that went down to like 102 or something, it's going to seem even more, it's going to amplify that panic even more, right? So I don't think people understood that there was that huge delta between places. So depending on when you're looking, that factored in. But it was short-lived. And I actually wasn't, I don't know if I just wasn't online or wasn't awake during that period, but personally, I did not notice how big of a wick down it was on some exchanges. And a lot of that was probably just the exchanges more so than anything. Obviously the order books and things can happen with liquidation cascades. But what impressed me was the strength of Bitcoin, honestly. Like, I get it. There's a lot of people that got liquidated. I think it was over 1 million people I heard. I don't know if that's accurate, but I did hear that. A lot of that's altcoins, really low. And that's I think there's so many lessons in this. One is liquidity. So I think it was a pretty rough wake-up call for people that are just looking at numbers on a screen with their altcoins and thinking that market cap, they can actually cash in, like whatever they hold. Say they got in early on some alt. Well, on the screen it shows they have this much US dollars, but the reality of the situation, if everyone runs for if everyone is running for the exits at the same time, there's not enough liquidity and buyers to support that. There's very few coins that actually have that, and Bitcoin is by far the most consistent there, right? So I mean, that is a huge thing in and of itself, that when you hold Bitcoin, you can actually be confident that you can sell and actually realize that value pretty much at any moment. Whereas these alts, it's just a complete crapshoot. You don't know what the actual liquidity is and if you trust it. So yeah, there's a lot we could talk about with that, but it's from my perspective, it was actually pretty mild. And I've been here through multiple crashes. I actually kind of went all in on Bitcoin during the COVID crash. And so that was, that was a kind of a big event. And so this did not feel to me anyways. I know I'm biased because of my cost basis. Like, when you have a lower cost base, it's a lot easier to hold through these events. I get it. Everyone's in a different situation, but yeah, I'm similar to you. It was kind of like another day for me, honestly. And more than anything, I don't know your thoughts are on this, but I was impressed with Bitcoin's resilience. And we only ended up being down like 10%. Went back to the short-term holder cost basis, nothing kind of out of the ordinary in the end.
Looking for a secure, trusted way to buy, sell, and hold Bitcoin? Gemini has been leading the way since 2014. Founded by the Winklevoss twins to be a security-first, fully regulated Bitcoin platform. With Gemini, your Bitcoin is protected with enterprise-grade security, backed by insurance and Type 2 certifications for SOC 1 and SOC 2. Whether you're new to Bitcoin or a long-time hodler, Gemini gives you the tools to stack sats and build generational wealth your way. From simple one-tap buys to advanced charts and trading features, it's all here. Buy, sell, and hold securely. That's Gemini. Gemini. Bitcoin with confidence. Need cash without selling your Bitcoin? With DeBiFi, you borrow against your Bitcoin, non-custodial, multi-sig escrow, and you keep your keys. No banks, no selling, just institutional-grade liquidity with terms up to 2 years and APRs as low as 9%. All transactions are signed using private keys on your own device. Using a 3 of 4 multi-sig setup, 3 out of 4 keys must approve every transaction, giving you control, transparency, and peace of mind. Whether you're a hodler, miner, small business, or treasury team, DeBiFi gives you the cash you need now without giving up your Bitcoin upside or triggering a taxable event. Get liquidity, keep exposure, and stay secure. That's DeBiFi. DeBiFi, your Bitcoin, your money.
I think liquidity is a crucial point, and I recall in the last cycle when Elon Musk famously bought $1.5 billion and then he sold about 500 million with his famous quip, just testing exit liquidity, and I think he was under some pressure to prove to his board that okay, you can get that money in, but can you get it out? And I think we've come a long way since then. When just a month or so ago we saw Galaxy liquidate on behalf of a client $8 billion worth of Bitcoin, and it barely registered on the price. You know, to be able to get out of an $8 billion position, we're talking about a 2 trillion plus asset now. It's not, you know, we're in a different era completely, and I'm not sure that a lot of people understand, like, oh, well, alts are still alts, right? All the shitcoinery that goes on and everything else that's other than Bitcoin, they're still struggling with liquidity, but Bitcoin has just gone, it's just at a different scale right now. And I'm not sure people understand that it's not Bitcoin and whatever anymore. Bitcoin is not even in the same universe as a lot of these altcoins that people are gambling with. And they need to start understanding that and stop making any reference to Bitcoin when they make their investment decisions, because it's just not the same thing. And it hasn't been for a while, but that's even more pronounced now.
Yeah, that gap is widening, I would say, and it's kind of it spirals as well because, yeah, big money can only, like you said, if they want to liquidate at any given time these multi-billion-dollar positions, there's just such a very small amount of coins. I mean, Bitcoin and maybe ETH. I don't know. I don't really follow ETH too closely, but I'm assuming maybe you could do something with ETH there. But outside of that, there's not much else, like if anything else. So, yeah, it's a moat. It's another moat for Bitcoin that is a significant moat that I don't think people understand because, okay, so some altcoin's gonna somehow pass Bitcoin because its tech is somehow better, Casper or something like this. It's like, did you see how Casper reacted during the crash? I mean, it went down like 80-90% at one point. Like, and that's just the liquidity just working, just showing itself in real time, right? So there's no way big money's going to touch an asset like that. It's nowhere near prime time. Most likely never will be. But we'll focus on Bitcoin, and I feel bad for everyone that was over leveraged, and I feel bad for people that had some tough lessons there. But hopefully, these sorts of events really do highlight the attributes of Bitcoin over everything else, and also make people understand that leverage is super risky, man, on any asset. And when these exchanges are doing shenanigans and just you're trusting these exchanges if you're leveraging yourself, and I wouldn't want to put my trust in these exchanges. They keep failing the space over and over. So it's like, so sorry guys, our order books weren't working. Your stop loss didn't work. Sorry. It's like, okay. So yeah, you got to be careful with leverage for sure.
I know, a lot of people roll their eyes, but it's true. Just Bitcoin, if you're going to borrow, make it non-recourse, so no margin lending. Take a personal loan if you must have that, but don't go into margin lending, right? And then have a job. I know it's not a sexy thing. People don't, especially in this place, in this overall space where a lot of people have made life-changing money and no longer need to work. It's kind of deemed to be unsexy. But I think the sexy thing is to have an income independent of what your the fluctuations of your portfolio. And so if you do that, that's a rock solid place to be in. You can afford to be patient. Once your money can be patient, you start to make much better sound decisions that you can stand behind, because you don't need to draw on that to pay your bills and put food on the table. And it's only in situations like this. I mean, as a community, we've had these conversations, after every bear market, and sometimes during bear markets as well. But people seem to forget those lessons very quickly when there's money to be made. And it just seems impossibly hard for a lot of people to resist the urge to lever up their positions. And some people lose their entire net worth because they just couldn't resist it or got carried away with the gains. And it's never worth it. Always look down and ask yourself, will I be okay if I lose 30%, 50%, 90%?
Yeah. It's important to ask those questions. And I think you're at a disadvantage as an investor if you don't have that income, because you could be forced to sell due to emergencies or whatever reasons in your personal life at the wrong times. You never want to be a forced seller at the wrong times. It's a hard place to be in. And so, I mean, it does help to have that. If you can at least cover your bills so that you can be more long-term. And I think what might have happened, this is just my speculation, but what might have occurred is, because we've been so consolidating sideways, kind of crab bull, this sort of pattern now for almost a year or so, I think people might have got impatient or were trying to get all the gains by using leverage and trying to create their own volatility, because we hadn't had that volatility. And I think that lack of volatility, you could call it, or stability in the price, especially with Bitcoin, might have, in a sense, lulled people to sleep, where they thought, oh man, this thing is the same price every day. I can take leverage on this. It's safe. Well, just because the price has been stable, don't forget how volatile Bitcoin can be. And that volatility is a feature with Bitcoin because it has liquidity. It is a feature because you want that volatility. For many reasons, it's beneficial. It's what allows that growth to be faster than other assets. And so we want volatility, but it's just, you're playing with fire if you're using leverage.
And the volatility keeps the market healthy, actually. Like, we do need these flush outs, right? So that excessive risk doesn't accumulate within the market. And we need, and the really beautiful thing about this, and I apologize if this sounds ruthless or heartless, if you're suffering from losses right now. We've all been there. But the really good thing about Bitcoin is there are no bailouts. No one's coming to save you. You eat your own cooking. And that keeps the market as pure as possible. And these flush outs, they're really important to happen, as well as bear markets as well. Because every time a bear market and a flash crash like this happens, it just cleanses the system. And so you, in addition to having an independent income, you also want to have flash crash money, bear market money as well. So, DCA what you don't want to touch for 4 years or more. And then you should also have, a little bit of a stash on the side just in case you get some opportunities like this. This is a really good opportunity, I think. What do you think, Plan C? Do you think this is an opportunity, or is it start of something a little more prolonged?
I think it just depends on somebody's, their horizon, right? So as long, minimum 4 years. I would even say I would aim for 8+ years personally, or even longer. But anyone that's thinking more in terms of 10+ years, we'll get into it later with the Quantile model. But that floor, mathematically speaking, as far as all the data and the patterns we've seen for Bitcoin on the math side, I was actually having this conversation with someone else. Basically, this idea of waiting, so people will be like, okay, I'm gonna, you're talking to someone and they're maybe not in the space completely yet, and they're asking them, okay, you're gonna buy Bitcoin. Oh, I'm waiting for it to crash. What they don't understand is, if they're waiting for it to crash, the floor of where it might go to in a black swan is kind of always steadily ticking up. So, and by the time that crash does come, when it does come, are they going to have the conviction to buy at that point? And if it somehow magically goes below those lower levels, and at that point you might that would be absolutely catastrophic. And so then you might not even want to buy it. I'm talking about extremes, like if we went back to 10K or less than 10K or something crazy, right? That's not going to happen. But that's the problem with these people waiting for that golden opportunity to come where Bitcoin is going to somehow go back to these levels that we've seen in the past. They don't understand it's just not going to happen.
Yeah, especially if the market continues creeping up as it does, as has been almost 2.5, 3 years now. The odds of a massive market meltdown like we saw in 21, 22 diminish with each passing month. Because, we just don't have that excessive leverage within the system. Whereas you could almost say the entire bull market last cycle was based on excessive leverage and rehypothecation, which, we're not really, there are no indications of that at the moment. Are you seeing anything?
Yeah, I'm not seeing the same, like 2021 cycle. That was pretty insane, especially with the lending of some of these platforms, and then of course with altcoins, there was a lot of that rehypothecation, like you said. So yeah, I wouldn't say I'm an expert on this subject by any means, but I'm not seeing anything nearly as risky in that regard. And especially after this flush out, like something like this. I mean, I'm not sure. I've been in the space kind of since early 2018, but have you seen anything remotely similar during a bull market? Like I know in 2017, that rally was significant. I mean, there was lots of multiples on that rally, but there was, I think about a dozen times or so, there was about a 30% pullback, or close to 10 times there was a 30% pullback. But was there these sorts of liquidations during that period? Because I wasn't here during that time.
Well, I think it's all relative. I was only around, so I'm in this space since 2020. But there's one thing that I guess we can all have a look at the charts and see what's happened in the history of this space. And one thing we need to keep in mind is that it's all relative. Like we've got a bigger asset base now, and so the daily candles get bigger, both green and red. And the liquidation amount, while we're making a record 19 billion in a single day, is a record in and of itself. We're talking for an asset base and an asset class that's, probably 10x what it was at the depths of the last bear market, right? So what was the bottom of the Bitcoin bear market was 15,500. We're not quite at 10x yet, but we were at 124, 25,000. So, that's only 25K short of 10x. So it's a much bigger base. And so what we're going to see is larger dollar denominated amounts in terms of daily rises and red candles, but also liquidation amounts as well. So but if you have a look at the chart right now, if you have a look at the Bitcoin chart right now, it hardly looks like a blip. Like in percentage terms, the dip wasn't all that much. It was barely 15%. It came down from about 120 something. Yeah, that looks like nothing at all. Like it doesn't even look like anything compared to earlier in the year, right? So we had, but for a single day that precipitated a liquidation cascade. 19 billion is the record for the ecosystem, and so I'm not sure we've had anything approaching that, but maybe in percentage terms, as a percentage of the asset class.
Oh yeah, percentage-wise, I think we've had some pretty big drops, and it's also the wick too. Like again, and how do you base it on? Because every exchange is so different. But this is daily closes here, and this chart is super simple, right? It's just moving averages. But I thought this was an interesting pattern that's played out, and yeah, I'm not saying this is going to continue. It's only a few data points, but it's been an interesting pattern since the lows, since we put in the bear market lows. Because so the red band, for everyone that's watching, the red band is a 200-day moving average. The orange band is 365-day moving average. And the interesting pattern I noticed is we've actually kind of consolidated and found the bottom between these two bands essentially 3 times so far over the last 2.5 so years. We've gone below the 200-day, but we have never gone below the 365. The 365 today just crossed 100,000. So the 1 year moving average, the 365-day moving average, is now at $100,000, and that is a result of us trading consistently over 100K now for a while. And so that's pretty significant, because you can see we bounced off the 365-day moving average, or pretty close to it, basically four times, you could say, twice in the one dip there. But you can see the consolidation and the time to kind of get in before the next move up was between these lines. Now, I'm not saying we have to go between these lines again, of course. I would not want to see us go below the 365-day moving average. I don't think in any bull market we've really gone below it. In the 2017 bull run, it was so euphoric we didn't really go below the 200-day moving average. But this kind of range here is between 107 and 100. So the 200-day moving average is at 107. The 365 is at 100. So it's just a level to watch for. We could potentially revisit that. These numbers are climbing quickly, though. These moving averages are climbing quickly. So depending on if we get there and when we get there, it could be a lot higher. The last thing I'll say is, if we go euphoric phase of the bull run, which I still think hasn't fully come, we probably won't go. In that case, we probably won't go back between these lines again. We'll probably stay well above the 200-day moving average at that point. So, but yeah, any thoughts on this kind of?
Yeah, just to put that in a bit of context, how much progress Bitcoin has made in a year. This time last year, 100K was almost a bit of a meme. And then, we were all sort of goading Saylor into holding a 100K party at his place on New Year's Eve.
Right.
And he fell for it. and so, and then something special and spectacular happened in November where Saylor's company strategy just unlocked something in capital markets, and it went absolutely crazy in the fixed income markets. And suddenly they were getting access to billions of dollars of Bitcoin every other week to buy. And you can see that massive spike just before January, and that was the November-December period. And we hit 100,000, but it was a precarious sort. It was more like a tap, and then it dipped back underneath, and people were making fun of everybody who went to Saylor's party, celebrating too early, top signal, everything like that. And you know what? For the first 3 months, a lot of people thought they were right because it dipped all the way into the 70s, from 100,000 down to the 70s. That's a 30% dip, right?
Can you see my cursor?
Yeah, we can see that. Yep.
Yeah, that was a big drop actually from up here to way down there. Yeah.
Yeah. And so, that really puts into perspective where we are now with this. I know the $19 billion liquidation is a huge figure, but it really puts into context what's actually happened this week. And when you look at the chart, you zoom out to a 3-year, since the bottom of the bear market, you zoom out, and it just shows you that actually this is just pretty normal behavior with Bitcoin. 15, 20%, 30% drawdowns. That's just standard. If you don't have money patient enough to see through a 30% drawdown, you need to get your affairs in order, because that's just a standard short-term drawdown. It's absolutely nothing.
You have to be able to stomach that volatility. Otherwise, you can't be in Bitcoin if you can't stomach that. And whatever you need to do to stomach that, if you're new, that's just part of it. And in the past, when people, past cycles, it was way more. But yeah, anywhere between 10 to 30%. I mean, that's just so standard during a bull run. And that's what allows the cycle to extend in a healthy way. As long as you consolidate after that, get support, and then you kind of grind back up, stay above key moving levels. We're still above the 200-day moving average. Like, it's at 107. We're above it right now. I know we're not above it by that much, but we're still above the 200-day moving average. And nothing on that chart looks like it's broken.
And the other thing is, I just posted earlier today, or it was yesterday, Bitcoin officially 158 consecutive days closing the daily candle above 100,000. Right, that was the point that I was going to make.
Yeah.
In giving that context where we were on New Year's Eve with a sort of precarious Bitcoin price in the 90s, and then the dip down to the 70s, and now we've had 158 consecutive days closing above 100,000. Right, that's incredibly bullish. Whatever it does from here, to me it just looks like just a short-term dip. We see demand on the horizon building. So, yeah, I'm not at all worried. I don't see anything worrying in the Bitcoin price right now.
Yeah, and it's been so there's been multiple storylines kind of during this bull run, and what's interesting to me, couple different things. So, I think it depends on the lens you're looking at Bitcoin through. So, if somebody is really focused on the 4-year lens now. I'm kind of agnostic on the cycle length. I personally don't really. I'm not actually using it as a timing metric. I understand that we have a couple cycles where Bitcoin has followed very consistent timing, right? It's been very consistent. We've always kind of peaked around November, December. The last three major peaks, you look at 2021, you look at 2017 and 2013, they all were in November, December, basically October, November, December. So they've all been Q4, the last three major peaks of 3 cycles. Now, 3 data points is not really that significant, although it is one of the major patterns, you could say. And then we've always taken about a year to kind of get down to the bear market, a year to get down to the low during the bear market. So it's kind of like a year of capitulation to the ultimate floor. That's been so cyclical and so predictable timing wise. And I think a lot of people, I've done some polls on my account and they've gotten a decent amount of votes, and it's about 50% of people. And every time I've done it, I do it every couple months, the number of people believe in the 4-year cycle is actually continually going down, which is interesting.
Yeah.
And so it was at one point like 70%. Now it's down around 50 or 40-ish. So yeah, I mean, I would say that if you're looking at through the 4-year lens, then a lot of people are thinking, okay, we're running out of time. Like, okay, Bitcoin has to make a move here. It has to happen now. And everyone thought, okay, it's going to happen October, November, and December here, October, November for sure. And that's what caused a lot of this leverage, is because everyone was on the same side thinking we're going up now. That's what's always happened. I think it's risky. I think personally speaking, I'm very much open to the cycle potentially extending. I think there's multiple reasons why that could occur. Some people will point to this when gold got its ETF, went on this huge run for multiple years. And again, I don't know, some people would probably have, nuance to speak to that, but there is that, that's what occurred with gold and just the price action we've seen in gold and silver. Gold and silver have performed so well as of recent. And so that's again, why I think, this cycle has a good probability of extending, is just looking at gold and silver, kind of leading the charge and expecting Bitcoin, as far as a scarce asset. I mean, it should be performing similar or make up some of that ground as far as the ratios. And then macro, I'm not an expert on macro, of course, but macro with rate cuts and things like this, there's just multiple reasons why, and just the stability, and like you said, the amount of days we've traded over 100,000, the fact that the ETFs are showing pretty good inflows right now. The treasury companies are there's smaller ones maybe that aren't doing as well, but the majority of them are still a good vehicle to get more people into the space and into Bitcoin. So those are consistent bids. We see those announcements. So anyways, those are all my reasons. There's more I could think about, but those are kind of the main reasons why I do think. And historically speaking, Q1 has actually been pretty good for Bitcoin. I know a lot of people talk about Q4 being so good, but Q1's actually performed well historically for Bitcoin also.
I thought Q1, most bull markets ended in early January. They have, yeah. But if you look at kind of like the means and the medians, Cena's done some work on this. Cena's on X. If you just type in Cena, he's done some work on this, and so is another account, Smithston. But basically, they've looked at different months of the year and essentially looked at the kind of mean and the median returns. Oh, okay. You mean like through the cycle, not specifically just bull market. Okay.
Yeah, just kind of looking at all exactly. Yeah, looking at kind of every year and just taking in this month we were up 5%, 10%, and then averaging it all out. And not to like the biggest returns haven't been in those months, but they have actually been good. I think February has actually been one of the top 3 or 4 months for Bitcoin, surprisingly. So yeah, it's mostly the summers and September that Bitcoin has struggled historically. So yeah, I don't know how much weight I put in that. I do put some weight in that for sure, the seasonality component, and I think that'll actually become potentially a bigger player. And that's just traditional markets and adoption into kind of the mainstream players. They do follow somewhat of a cyclical cycle, go away in May or whatever. The whole idea of, the summer months and then coming back. And it makes sense because if people come back in September, say for the holidays or whatever, it takes them a month to kind of figure out what they're going to do. And then they allocate in October more. So it kind of does somewhat make sense anyways, but.
Yeah, I'm very much leaning towards the 4-year cycles had some value. I guess that was founded in mathematics, like supply and demand being cut. But like the halving now is just, it has meme value right now. Its mathematical significance on the supply side is really quite small now. I don't know that too many people
I
are still
agree.
holding on to that.
So, yeah, I would wonder how many are. I mean, the 4-year cycle still has a good amount of traction for sure, it seems. But yeah, the specific drivers of the 4-year cycle, as far as the stock to flow idea, I think it was more. Well, I would say yes, it could have been. So the halving could have been the driver or one of the main drivers during, say, the 2013 run, even the 2017 run. I do think definitely this run and even last run, it hasn't been as big a driver as people think. And yeah, I think at this point it's really not. It's a narrative for sure.
Yeah.
I do think it's there's a psychological factor. So one of the things that I definitely am interested to see, and it's probably playing out now, but it'll definitely play out in November, depending on what happens in December. There's a percentage of people that still believe in the 4-year cycle. So they're going to sell whatever percentage they've decided they're going to sell, like based on their strategy. I don't know, maybe they trade a percentage of their stack or whatever they decide to do. Everyone's different. There's probably a percentage of coins and sell pressure that's going to come on. And that might have already started. That probably has started. There's people trying to front run that idea, that narrative. So I would say we're already in that phase where there's people that are starting to sell because they believe in the 4-year cycle. Now, assuming that's the case, and collectively it could be a significant amount of coins coming back on, with the assumption they can get back in lower, which is the interesting thing. Because they're assuming, okay, the cycle's over, I'm gonna buy back in lower. Now, assuming that we don't end the cycle in Q4 and Q1 starts, whatever amount of coins have been sold, from those people that are believing the 4-year cycle, if the price doesn't collapse or if it recovers quickly, it'll be interesting to see how it plays out, because you could see those people kind of FOMOing back in, being like, oh shoot, we're extending, right? So it works in both directions. It's definitely a headwind right now. I would say there's a headwind, which is the psychology around the 4-year cycle and people believing in it more than anything. But when we get through that, that's actually becomes a tailwind for Bitcoin, because now everyone's like, okay, this thing's going to extend. We don't know how long it's going to extend for. And then at that point, all bets are off because we're in uncharted territory. So that could make that's why I think if we can get through Q4, even if we don't have a crazy euphoric blow off top, right? Like we don't go to like 150 or 200. Say we just stay between 110 and 130 or 110 and 140 for the rest of the year. That's actually super bullish in my opinion, because that gets us through this narrative. And then at that point, everyone's going to want to be allocated, because if you don't understand what I'm saying, like it becomes a tailwind in Q1 that could propel us, into a more extended cycle. I mean, yeah, I mean, it's, and there's a lot of obviously drivers like liquidity, global liquidity and things like this. But yeah, what are your thoughts around that? Like,
no, I agree with you. I think you've laid it out pretty well. The narrative friction of the 4-year cycle has some people thinking that they can, front run whatever may happen in late Q4 and maybe early Q1. But if we do break through that, we've just got just blue sky in front of us. Anything is possible after that. There's really nothing holding us back, and there's no sort of mimetic narrative about the 4-year cycle being over, so there's a bear market. If we keep holding through till March, April, then we could definitely look at another leg up for the rest of 2026. And in fact, that's when we get some fresh air and some new space for the entry of new memes. And that could well mean that, people start having a look at some other analogs. And one of the things I've been looking at is Amazon's performance for 20 years after the dot-com bubble. It was just basically a 20-year bull market and punctuated by numerous massive drawdowns that, kind of lend themselves to a comparison with Bitcoin. Bitcoin's going to have massive drawdowns, but within a range that constantly points up. It's okay, it may not last 20 years, but could it last 6, 7 years? That's certainly possible. We've already had 3. So who's to say it can't go for another 3? The business cycle is turning. The interest rates are falling. Liquidity is about to go up. Monetary debasement. We've just heard Treasury Secretary Scott Bessent call for Trump to have emergency powers to stabilize the economy in the case of a trade war with China. So we have all of these things as tailwinds. I don't see too many headwinds.
Yeah, that's the interesting thing, right? Like the only headwind, or one of the only headwinds, is this idea we have to go into we have to go into a bear market in 2026. Like that's one of the only headwinds I see, is people being like, "Well, 2026 should be a bear market." It's like, but if all
Why?
the signs are pointing to, like, if there's all these other reasons, and this is the thing, right? Like again, I put so much more weight in other patterns than the timing element, because as much as we talk about this 4-year cycle, and it's really ingrained in Bitcoiners, it is only 3 data points. Statistically speaking, especially when there's a phase shift in Bitcoin itself, and I think we've gone through that. I really do. I think we've crossed the chasm for Bitcoin, and yeah, I think you get to a certain point, and yes, there's going to be pullbacks. Yes, there's going to be corrections. That's healthy and that's expected. But to think we have to go into an extended bear market and it's going to pull back, 70, 80%, I'm not convinced of that. I'm convinced of pullbacks, but we could be literally just staircase up for the next multiple years, and okay, yeah, maybe globally there'll be something that throws us for a loop at some point. But those events tend to be relatively short-lived. I mean, COVID, we bounced back extremely fast. This liquidation news, we bounced back extremely quickly. So I could see, some big wicks down, but then right back to kind of where we built stability.
Mm-hmm.
And then we just keep that climb going, and it's steady. It's not like a euphoric top. And that is a pattern change, because you got to think the first few cycles were massively retail driven. The first few cycles were low liquidity, and they were thin order books on these exchanges. And so the price, you could move it way faster, and there was a lot more volatility. And so that would, and plus the halving did play a big role back then. And so for all those reasons, I think that phase shift has occurred to the point where, yeah, I'm starting to be more and more in that direction. And I think the frustration of people this cycle, when they kind of realize that there's been that shift and they're not comparing to past cycles, they'll start to realize that this is actually in a lot of ways preferable. And yeah, like you said, looking at these other assets that go in these huge tears over a period of 5 or 10 years. I mean, why can't Bitcoin do that? The market cap's still only $2 trillion. It's still small considering the use case. Global store of value and all the other use cases you go into. I mean, yeah, it's a good time to be in Bitcoin if you have that long-term perspective, and there's nothing crazy to panic about. And here's one other chart just on short-term, relatively shorter-term stuff. So I just wanted to show this because this shows like the amount of profits, essentially unrealized profits people are sitting on right now.
Tell us the title of the chart.
Well, this is actually from Check on Chain. So this is actually Checkmate's website. I didn't create this chart. I just went to his site. But key cost basis. Are you looking at the same one? Key cost based models.
Yeah.
Okay, perfect. Yeah. So I mean, you can kind of decide which ones you want to put on the chart here. So I just thought it was interesting to look at the short-term holder cost basis and the true market or true mean price. So short-term holder cost basis, for people that don't know, it's essentially the average cost basis. You could look at it as a weighted moving average, because if you're looking at, say, for an example, the 200-day moving average, what that does is simply take the last 200 days and just take the average price of the closes, but it doesn't factor in the volume. The interesting thing about the on-chain cost basis, they actually factor in volume. So the short-term holder cost basis is the last 155 days. So everyone that bought in the last 155 days, but it factors in the weight of the volume. So it is the cost basis of as close as they can get with on-chain, the true cost basis of short-term holders, which they categorize statistically as the last 155 days. So we're at that cost basis right now. We're probably a few K below it. So those short-term holders are not sitting in any kind of profits. Now, that's actually not a bad thing. You don't want to see us go too far below that short-term holder cost basis. And during a bull market, you want to see us stay above the short-term holder cost basis, but not too far above it. So the Goldilocks zone is basically above it, but not too far extended above it. Because if you get too far above it, there's an incentive for those short-term holders to take profits. If you get too far below it, then there's a risk those short-term holders are going to start capitulating, which happens during all the bear markets. And during the bear markets, if you look right over here, one of the characteristics of a bear market is you can't get above the short-term holder cost basis. So you go here, you get rejected. right? You try again, finally break through right here, right? That was a huge signal. And then, you find support. You do dip below it at times, but you don't want to go too far below it. So that's the short-term holder cost basis. Basically, right now, we're pretty much, there's no profits in aggregate. It's looking at all of them in combination, their cost basis. And then down here is actually an interesting one that a lot of people don't talk about. This is called true market mean.
That's the blue line you're pointing at.
The blue
right
line.
now.
Yeah,
Yep.
exactly. Yeah. It's called true mean price. So this one is interesting. It's at 81,000 right now. And what it is it's the best estimation of the cost basis of the network. So the overall cost basis of all the coins that are active when you remove like lost coins and Satoshi's coins, because that throws off the cost basis. So if you remove the coins that'll probably never move, and there's different ways that Glassnode does this. They have their own, buckets they put things in. But their goal with this metric is essentially to say this is kind of like the cost basis of all Bitcoin holders that'll probably ever sell or have the opportunity to sell, removing, like I said, all those lost coins and Satoshi coins. So 81K, I mean, that, we're not that far above that, right? So there's definitely some profits in the market, of course, but it's nothing excessive. And, it's just an interesting level. That's essentially a level that, it gives you a sense of how extended we are. And we have gone below that, during bear markets, like it's happened, but it doesn't mean we have to go below it to the same extent we have in the past. Especially if we don't have the upside euphoria, and that's the other thing. If we were to go in a bear market, say in the next few months, I think it'd be a pretty muted bear market because we never saw like that true blow off top. So maybe we don't go down nearly as far as we have in the past. That's another way to look at it. But anyways, I just thought these were both interesting just to understand, if you're in Bitcoin, okay, the average person that holds Bitcoin right now, their cost basis or what they bought it at on average when you put all the coins together is 81,000.
So Plan C, just touching on that point you made about a bear market, but a rather muted one. Like we could see a continuation of this entire 3-year pattern. Realistically, in the next 3 months, Bitcoin pushing up to like 138, 145, and then draw down 30% from there, which would bring us pretty close to 100,000, right? And it would still be business as usual. It would still just be a repeat of what we saw earlier in 2025, this year.
Yeah, we spent a lot of time in that range. I don't know if you would remember, but yeah, pretty much. I think I can't remember the exact levels, but there was a lot of time we spent kind of between 50 and I want to say 60,000 or 65. Like there was a lot of days we kind of traded there, and then we just shot up. When the election and things happened.
It was about 9
Trump.
months.
Yeah, exactly. So initially, I thought that's where the bottom of the next bear market was going to be. I thought we were going to go all the way back to there because we were putting in a lot of support there and a lot of days trading kind of in that range. So I thought, okay, this could be the floor of the next bear market. I'm starting to think more and more that it's actually going to be close to 100K. Whenever that bear market comes, I am starting to lean more and more towards the extended cycle idea. But just like you said, I mean, the amount of days in a row we've been above 100,000, the volume that's moved above it, the 1 year moving average being at 100,000 now, there's a lot of support there. I mean, maybe it's wishful thinking, but I just, depending on when we get there, say it's next year sometime, whatever we get to, it's possible that ends up being our floor because based on the amount of days. I'm focusing on like the actual amount of volume traded. There's kind of those two major zones, right? Or between like 100 and 120K, you could say, and between that 50 to 65 range or whatever, there's a lot of volume that move for an extended period of time in those two ranges. So I do think one of those will most likely be the next bear market bottom. Just my thoughts. Could be wrong on that, of course, but
don't you think that if we do push through and break down this 4-year cycle narrative, that without a blow off top, there is no bear market. It's just a continual wave of adoption that's punctuated by, pretty regular drawdowns that we've been accustomed to seeing, like, 20, 30, 40%, but no prolonged bear market. Like we're not going to be seeing a year of going down and then a year of recovery.
Yeah, exactly. No, I'm more in that camp. I really am. And I think more and more people are actually kind of going that direction kind of all the time, I would say.
So let's take this opportunity to talk about your quantile model, because you've gone to all the effort to build it. Tell us what made you want to build this model, and what is the foundation for this model that makes it different from the others?
Yeah, so it's been quite a journey with this model, and it's actually been a lot of conversations with a lot of very smart analysts, and it's been kind of a collaborative effort. So a lot of people might be familiar with the power law, and the power law was discovered by Giovanni, I believe. I can't remember the exact times, but I know as far as the price relationship with log price versus log time, or log price versus log price versus hours since the Genesis block, or hours since the Genesis block. That was in 2018, I believe he discovered that. So I kind of came across the power law about just over a year ago. And at the time when I came across it, all I could see on it was basically Giovanni talking about it. And I looked at it myself, and I've been studying Bitcoin now for 5 years full time. I got a top subscription to Glassload for a couple of years. I was looking through all the on-chain data, all the metrics, and I kept coming across this kind of pattern where there was it looked like a diminishing return pattern for the actual peaks of a lot of these metrics. So a lot of these indicators and metrics, I was like, okay, they're interesting, but the pattern seems to be that we don't necessarily get as high on some of these metrics. And so how do you assess where we're going to actually get to, and how do you kind of deal with that? So that was in the back of my mind, but essentially looking at all the on-chain data. And then when I came across the power law, I was like, okay, this is interesting. This is different. This is more of a statistical pattern. But at the time, there was essentially just a line like this drawn through the data set. So this image is actually, it's looking at it. The chart in front of you is log on the y-axis, right? So that's the log of price. The x-axis is in linear. And I do that because visually it's more intuitive for people to understand. Otherwise, you get a straight line and you're compressing time with log. So it's unintuitive to humans because we perceive time linearly. So initially when I saw this power law idea, Giovanni was showing these charts mostly in log space. So it was a straight line. But it was hard to kind of interpret and visualize as somebody that's looking at linear time as a human. So you can take the actual underlying data of log, and you can convert it into log linear, so it's easier for people to perceive it. So that is actually a big advantage. The other thing was there was essentially just a line through the middle, kind of like a fair value or a mean. So he was using something called an OLS fit, but it's essentially a line through the data. But there was no way to kind of quantify how far you're from that midpoint and actually model the top half of the data set. Because the power law is very useful for modeling the bottom 50% of the data set, but it's actually not that useful for modeling the top 50% of the data set. So there's a big distinction there. And
when you say the lower end of the data set, are you talking about the lower price range within a cycle?
What I'm talking about is, so for example, on this chart right now, this line that's drawn through here, I didn't draw this. This is a statistical regression. This is something called quantile regression. So it's actually the median. So it finds the best fit through the middle, essentially, of the data set, and it's more robust to outliers. So there's two different fits you can do, main fits. There's a median fit and a mean fit, right? One is an average, and then one is the median, or the middle value. So this is the median. So and what this does is it's essentially, you could say this is fair value. It's a way of looking at the fair value, because you've spent an even amount of days above this line and below this line.
I see. I got you. Yep. Okay.
Yeah. So half of Bitcoin's, if you look at all the days, so actually look at hours. So I look at hours since the Genesis block. So it's over 133,000 data points, and it's hours. So half of those hours we spent below this line, and half those hours we spent above the line. But it actually doesn't overweight the extreme peaks, whereas a mean is an average. So it actually kind of overweights all these extreme peaks. So this, to me, is the best way to look at it, is the median, because it does capture the true pattern and isn't as affected by the outliers in the data set. So when you have this is kind of the foundation. So this is when I stumbled across the power law. This is essentially what I was looking at. was a line like this, but in log space, which was what Giovanni was. It's more of an observation. The power law is a great discovery. I give obviously Giovanni credit for that. It was an observation, but you still have to build a model around it. And you still have to say, does it represent the full data set or just the bottom? So it really well captures everything below this line, but it isn't that useful above this line. And because it doesn't factor in something called a decay function. So basically the power law is an important observation that when you understand it and you combine it with other patterns, there's another very important pattern with Bitcoin, which is the decay function. When you understand that, you can actually build a true model around it. And that's why the Quantile model is unique, because it's a full integrated model beyond just the observation of the power law. It makes it actually useful. And it makes it so that everything is based just on statistics, and you can say the exact amount of days you've spent at every level, and you can quantify it. So yeah, I hope that makes sense. Was there anything?
No, that makes perfect sense to me. So where do we take it from here then?
Yeah, so I'll just kind of walk through what I did, and then we can go to the main visual. So with this one, what I essentially do is I start with this median quantile regression, right? And then from there, I actually remove all the data above this line. So I remove all the data above this line. And the reason why I do that is because I want to isolate the bottom 50% of the data, and I don't want the top 50% to influence, because there's two very distinct patterns happening here. There's what's called, you could call it the power law, or linear quantile regression is another way of phrasing it. But essentially, it's that pattern for the bottom 50%. And so that's more the long-term stability kind of adoption. So if you look at Bitcoin, I'll just explain it this way. If you look at Bitcoin, it's a network of networks is one way to think about it. And it's a network of networks that is stabilizing over time as it goes through its adoption curve or adoption cycle. So as it's gaining adoption, it's gaining more and more stability. The market cap's growing, there's more thicker order books, lower volatility, bigger players entering, more stability of the overall network. And that's not just the price, that's also the hash rate, that's everything. Everything to do with Bitcoin is growing in stability as a network, right? And so as that's occurring, right, as that stability is occurring, that is essentially what the power law captures really well mathematically. It captures this long-term network of network stability growth, and it follows a specific pattern. And so what I do is I remove all the data above this line, and then I actually run another one of these median quantile regressions on just the bottom 50% of the data, right? So the data below this line, I run another median quantile regression on that. So you can imagine another line kind of going, through this bottom 50%, right? And the reason why I do that is I want to capture the true pattern of the bottom 50% of the data. And when I do that, you can take that, and then you can basically take what's called the slope and intercept. So it's essentially the mathematical pattern of the bottom 50%. You can take that slope, and you can, I actually do 500 fits for the bottom 50% of the data. So it's 500 different quantile regression fits, all using the same slope. And the reason
what's a fit, Plancy? What's a fit?
So basically, you can use, from a statistical standpoint, you're essentially like quantile regression. Okay, so quantile regression, you're taking, how to best define this? I mean, it's all based on math, right? So I'm obviously not doing, because a lot of people are used to TA. So they're used to people drawing lines on charts, finding support levels. This is completely different. None of this is related to specific patterns, that people use with TA. This is all math-based. So it's essentially finding I'm not finding the fit myself. I'm putting in the code, right? There's actually 1,500 lines of code that go behind the Quantile model. That code is basically telling the computer to run all the formulas. So it's the one running all the formulas and determining this is the best fit, right? So this is capturing the pattern. So that's essentially what these fits are. Depending on what type of fit you're doing, it's a statistical mathematical fit. And just like you would, here's a simple example, right? Like one fit, say you have 10 people's ages, right? And they all have different ages. Well, if you wanted to find like the median fit, you'd find the median fit of those 10 people. So this is obviously more complex than that, but it's the same principles, right? So it's not like it's debatable. It's like, no, this is the fit for this type of regression, right? And so does that make sense? Or maybe I
Sure.
explain that?
Yeah, using a statistical method to find some kind of some kind of trend within the data set.
Yeah, exactly.
Fit,
yeah,
right?
exactly. You're using math and regressions to essentially assess, are there patterns here, and to what degree, do we have these patterns? So there's a lot of different ways you can do it, but essentially this is very simple actually. Like from a regression standpoint, this is pretty straightforward at this point. So we slice the data set in half. You could say remove everything above it, which is more it's not so much the core trend, it's more these bubbles on top of the core trend, right? And then you have the core trend underneath, and then by doing a second regression on the core trend, you can find the middle point of that pattern. And then you take that, and what I'm doing is I do 500 different fits. And the reason why I do that is because I want to have one for every 0.1 quantile. So it's just a personal choice of precision where I want to be able to say for every 0.1% of the data set, I have an actual fit in the line that I can use. So for the bottom 50%, 500 fits, right? And so they all share the same slope. And so it's impossible for those lines to ever cross. So let me just pull up one more chart here. So it's actually important because essentially with quantile regression, some people say, okay, well, what happens if the lines cross? They can actually never cross statistically. It's impossible at any point in the future. So I've actually designed it that way specifically that they can never cross. And so that's actually, I'll pull up this chart here. Okay, can you see this on the screen?
Mm-hmm.
Oops. Okay.
Yeah, we've got 4 spikes.
Sorry, this one. Yeah. So once I find that core bottom trend, and then I apply that to the 500 fits, what I do then is I take that middle line that we had in the last chart, and I do ratios of everything above that. So with this chart, if you look on this side, these are the ratios of the price and how far it got above that median fit, right? That the line we're looking at in the last chart, I'm doing a ratio of every data point above that and looking at it in terms of a ratio. So you can see this is way back in early days, right? But we actually got extremely high here. This was, say 28 or so times higher than that median value. And then you can see it's gone down. This cycle went down to roughly 15, and you can see it went down to roughly 7.5, and you can see it went down again to whatever this would have been, say like 4. So there's a clear pattern. I mean, I can tell people, like, this is the thing. People get more engagement when they just present hopium, right? They say, okay, Bitcoin's going to $1 million a cycle or whatever. It's tough as an analyst that's actually just looking at the data and honestly trying to convey it. That still, of course, wants to get a lot of engagement, right? Everyone wants engagement. It's fun. But at the end of the day, this is the pattern. No one can deny this pattern. This is a clear decay function of Bitcoin. I hate to break it to people, but the diminishing returns idea on the extreme peaks above the core trend of the power law is a clear downtrend. Now, could it break? It's theoretically possible. It does appear to be a clearer pattern, but it is still a limited amount of data points. And there are caveats. If the US dollar breaks as a denominator, that could completely change this, of course. But will the US dollar break in the next few years and become like a third world currency? Probably not. It could happen, but probably not. I think it's still going to take a while, at least a decade or more. You can also denominate Bitcoin in gold, and that's another way to do it. And I want to work on a quantile model versus gold. I think that'd be useful. But as long as the US dollar remains stable, this pattern continues to play out, right? You can see where we are here. We're just barely poking ourselves above that median quantile regression. So yeah, I don't know what your thoughts are on this. This is probably, some people would say this is a bearish chart or whatever.
It's not really bearish because, okay, it shows diminishing returns, right? So that's been a clear pattern. But what I wonder is now, do we reach an inflection point where all previous trends are broken? As Michael Saylor's famous for saying, all your models are broken. So that, there's quite a clear trend in what you've modeled there. And I see that in a lot of models. I guess before anybody presents any of their work, they need to be able to see a trend that's worth sharing, right? But like, at what point do these models break down, or what would falsify them? What would demonstrate?
Yeah, for me, I mean, to falsify. So I have two main patterns. I'm not attached, like the quantile model is completely agnostic to the length of the cycles. So you don't need to factor in any lengthening of the cycles. What I primarily look at is what quantile we're at. And there's a lot of value with that, because you can actually say what percentage of the time have we been above this point. And you can actually quantify specifically based on all the hours since Bitcoin's, since July 17th, 2010, when it kind of first started trading on Mt. Gox. So as far back as we have access to reliable, useful data, this incorporates it all. And so my biggest thing with this is what quantile are we at? And this gives a good reference point within the data set, regardless of where we are within the timing element of the cycles. Now, as far as saying, this pattern breaking, there's two main things. So the bottom 50%, right? So with the blue and the gray is 1 to 20 quantile, and the blue is 20 to 50. So these bottom two bands represent below that midpoint, right? So 50, you could say 50 is fair value, right? And I put deep value for the gray. I called the blue discounted, because it is discounted. It's below the fair value, you could say, or the median of the regression. The yellow is I call it premium, because it's essentially above that fair value point. Right now we're at 56, right? So we're just a bit above that. That range goes all the way up to 80. And then above 80, you start to get more in just kind of a speculative point where you could still see big returns, but there's also increasing risk. And then the very top, you have that gray where we've always peaked, and that's the top 5% of the data set. So we've had 4 peaks or 5 peaks, we had 2 in 2021. So 5 times we've got to that top gray band, and essentially that's been the peak. And Bitcoin only spends 5% of the time there by definition, because it's above the 95th quantile. So the two patterns going back to it is that bottom base. So those bottom two bands, like 50 quantile or lower, that's the core. You could call it linear quantile regression or power law trend line. That's the adoption curve. That's the long-term pattern for Bitcoin. So I'm confident in that. There's really good math to support that over the last 15 years, and it actually keeps growing in its R squared and its strength. So the bottom two bands are seeming to be very solid. The 3 ones above it represent the decay function. So that is the best fit, essentially, to model that. So I do 499 fits on the top 50% of the data set, all the way up to 99.9 quantile. And that's capturing every 0.1 quantile, and it's best capturing that decay pattern we saw in the last ratio chart. And it's actually a very good fit as well. Everyone talks about the power law and how great it is, but if you're using what's called an exponential decay or a stretched exponential decay, there's 2 different versions. This model actually runs both of them. So the code actually runs exponential decay and stretched exponential decay. They're very, very similar. It runs them both, and it actually determines which is a better fit based on different tests and statistics. So essentially, what it's doing is it's combining those two patterns. And so, and I did quite a bit of research on networks that follow power laws over long periods. And they actually are very common to see the majority of the time with exponential decay and stretched exponential decay. It's actually the most common pattern that's found if you look at a lot of the research. So I thought that was super interesting, because that's what we see here. We do see those patterns together. And if one breaks, I think both will break. So that's what I haven't heard anyone else really talk about that. But I do think that if either the decay function pattern to the top breaks, then the power law, in my opinion, is probably broken as well. And if the power law breaks, then of course the decay function is also going to break. So they're both interdependent, and everyone's focused on the power law, but the decay is very important. It's actually a result in a way of the power law, or they're kind of interconnected. So I don't know if that makes any sense.
It makes perfect sense, and you've explained it extremely well. The question I have in my mind is, you spoke about potentially the models breaking. Have you given much thought about the potential scenarios that would give rise to these models breaking?
The biggest one is just the denominator, the US dollar, just losing its ability to hold stability. That's my biggest X factor, is simply the US dollar collapsing. But I tend to lean towards that's not going to be in the near future. It's going to happen at some point. All currencies essentially do fail at some point. But yeah, I don't see that happening in the near future. And again, you can model this in gold, and it's different, but it still holds some of the same principles. It still has that power law and decay function elements. It's not quite as clean, but you can still model it versus gold. So as far as what would break this, I mean, it would take an insane white swan to the upside. It would take something that is way beyond or 10x more than anything we've ever seen, but it has to be proportional, because every cycle it takes something, you know, way more significant, because it's always relative to where you are in the growth and the adoption. So we need a white swan so significant, right? Hopefully people understand white swan, opposite of a black swan. So an unknown that is so bullish that we just blow through the top of this pattern. And if we blow through the top of this gray line somehow and stay above it, I'll be the first to admit that decay function is no longer valid. It's going to take something pretty extreme for that to occur. Of course, same thing. If we spend, you know, a significant amount of time, months, and, you know, trading well below this bottom band, then yeah, I mean, the power law is broken.
But I'm just looking at your chart right now, and at the top end where it says historic peaks, 95 to 99, part of the quantile model, right? And that's well below 300,000. And we've got 2 years to run on your chart up to 2027. So a lot of people are predicting, you know, Bitcoin could quite well run up to 200, 250, sometime early to mid 2026, for example, right? And that goes dangerously close to breaking your quantile model there. Are you saying that that's extremely unlikely? Is that what your model is suggesting?
Well, this top, just so people understand, this here, this number is the 99.9th quantile. So by definition, we only spend 0.1% of Bitcoin's historical hours at this level. So, you know, that is, what would that be? So that would be 130 hours we've ever been at that level. So those are extremely short-lived periods. So that is the peak of the cycle. You know, those are very hard places for anyone to be selling. We're talking about like the most extremes, right, at the very top. But if you look at the whole band and you look more in this kind of range, right, if we kind of look at it more as a range between 95 and 99.9, I mean, these are reasonable numbers that I think, you know, are achievable, but not just pure, you know, fantasy or hopium. I mean, it's just like, okay, so for example, right, and this, I think in a lot of ways for me, like this sort of a model builds conviction in holding Bitcoin long term. Your core conviction should just come from understanding what you're holding and just researching Bitcoin, at least in my opinion. That should be kind of the core conviction. But this does also help in the way that for people that like looking at the math and things, it gives at least me more conviction, and it also sets realistic expectations as well, because I think it's important. So for example, for anyone who thinks this is bearish, I mean, the median value in 5 years is 515K. So basically we're looking at, you could say a 4.5 to 5x on just the fair value of Bitcoin over 5 years. Now, it might not be as much as some people want to hear, but a 4.5 to 5x over 5 years is good returns. And again, these extreme kind of peak points. Yeah, like what are your thoughts on this? So essentially, say 9 months from now, that's middle of next year, 227 to basically 300,000. Yeah, if we go to 500K in the middle of next year, this model's broken. At least, you know,
But even less than that, I think there is a risk of Bitcoin going, well, maybe not 300,000 within a year, but you know, I give that like a 5% chance. But okay, those numbers are different to what I'm looking at on your chart, because your chart's got a top limit of 300K, and then time-wise it stretches to 2027. So that's
Oh yeah, no. You got to look at
Okay, I'm looking. Gotcha.
Yeah, this is for the actual chart itself. This is this. So don't look at it in that way. Look at it more in this row is based on today. This row is 3 months from now, and then this is 3 years. So you have to kind of do your own calculations.
Gotcha. Yeah.
So maybe that makes more sense now, right?
Yeah, it does. I mean, yeah, in a year's time, do I think Bitcoin's going to be 100,000, I think, probably a 5% chance. I think that's about right. I think
to
that's
get to the
right.
top band. So yeah, if the cycle does extend, say another year, and say we end up peaking at the end of next year, just as an example, to think Bitcoin could be between, say, 240 and 300 or something, it's reasonable, right? 250, 240 to 300 range in a year from now, definitely reasonable. Nothing too insane, but yeah, these numbers, like people say, well, where's the $1 million Bitcoin? Well, it's not here yet, at least on this chart, because this chart looks 5 years into the future. I didn't want to model beyond 5 years. Some people will, but I actually, with statistics, if you have 15 years of data, going out 5 years is a reasonable period to model out as a ratio, because you have 15 years of data, you're modeling out 5 years. It's a 3-to-1 ratio of data to projections. If you start projecting out 10 years, I would argue you don't necessarily have enough data to do that, and it's kind of irresponsible. And so I think 5 years is a good amount of time to be projecting, and no longer. But every day that goes by, this is 5 years into the future. So this number will tick up because it's, all these are projecting into the future, these lengths of time. So these change as we increase our days, and everything will change. But basically, the 1 million Bitcoin for this top band, it's with this model, it's within the next 7 to 10 years is more of a what this model points to. So yeah, that's just the data. I mean, I'd love to tell everyone we're going to get there sooner, and we could. I mean, maybe this is completely wrong, but I'm pretty confident in this. To be completely honest, I spent months developing this, and I do think it's one of the best, if not the best, kind of investment frameworks. It's not a trading model. I don't advocate trading, just so people are clear. I'm not saying go out and leverage trade with this. I definitely don't want people doing that. It's a tool for long-term conviction and just understanding what the data points to, and then you can have your own interpretations of it, or whatever. You disregard it, or you have your own theories, or you kind of watch to see if it'll break or not. But I think it's a useful framework for most people that just want to hold long term. And if you want to take some lifestyle chips off the table at some point, say people got in really early, or they've been in the market for 10 years or whatever in the future, and for whatever lifestyle reasons they want to take 5% or 10% off the table or whatever of their stack, they can at least assess what kind of value they're getting relative to the data set. So if they're selling above the 80th quantile, you're like, okay, I'm getting a decent amount of value. I don't want to be selling down in this 20%, this bottom band, right? You're getting low value for Bitcoin. Some people, of course, would say never sell. You're never getting the value if you sell to another asset. But I'm not talking about selling to another asset or trying to sell to get back in. I think that's a dangerous game, because anytime you sell, assuming you can try to get back in lower, you're taking a huge risk that Bitcoin just doesn't come back. And we could never go back down to this bottom band for all we know. We could just stay in these 3 middle bands, and everyone waiting down here for this bottom band, it might never come. We never actually got down to the bottom band during this bear market, right? So right here, we actually found support at the 20th quantile. Back here we were in the bottom one, but it was actually COVID that brought us very briefly. And these are short-lived periods, so maybe you can't get in here. So, yeah, it's a tool that, like, again, long-term conviction, understanding long-term patterns, just based strictly on math. No extra narratives, no extra hopium. It's just pure math. And then if you want to sell for something, lifestyle-wise, like really upgrade your life, okay? Because I don't know what your philosophy on this is, but I have a philosophy that the only thing more valuable, well, not the only thing, but one of the things more valuable than Bitcoin is time. Time is actually unknown scarcity. So Bitcoin is known scarcity. There's a certain amount of Bitcoin there'll ever be, and that's scarcity. But it's known scarcity. Time is unknown scarcity, because nobody knows how much time they have left. It's a scarce asset that you also have this curveball that it could end tomorrow. And so that's why I put time above Bitcoin in the hierarchy of value. And so for me, it's actually logical to sell a percentage of your Bitcoin if you can meaningfully improve your life in a way where you can spend time with your loved ones or create lifelong memories with your loved ones.
I agree with you 100%. And especially if you want to create security for your family, like there is no price you can put on having a family home.
Exactly. Yeah, that is different than going and buying gold. Not to say that you shouldn't have something in gold or whatever. Everyone makes those decisions. But when you're living in a house, a house that your dream house, or just a nice house with your family, I mean, every day people will say, well, that asset might not go up in value, but how much value you're getting every day you spend in the house with your family. So it's a bit of an intangible value that is really significant. So these are philosophical things, but I do see this model to me is more about that. It's more about, okay, if I am going to sell for lifestyle reasons, let's assess where we're at quantile wise to at least understand what we're getting. And that way you can hold off. You can say, okay, because this is another thing that I don't know if people talk about too much, but the pressure sometimes from partners that people might have to sell at certain points, right? If you're married to someone, you make your decisions together, whatever. There could be pressure, but if you show your partner something like this, you say, "Look, let's just wait till we're at a higher quant." Maybe it's wishful thinking, but it's like people can kind of hold off for a period of time on some of those purchases and understand. Okay, well, what if we wait, another 5 years and try to sell in this range, right? Instead of selling, somewhere here as a number, right? So we try to aim for this instead of. Can you see the squares?
Yeah, I can see your
Yeah, you kind of look at something
cursor,
more in this range or even like this as a target, right? Versus something like this or whatever, right? It's just a way of kind of understanding. Just understanding it long term. So
I think it's a very sensible model and a sensible framework for making decisions. I guess, I'm a bulltard. I always think unreasonably to the upside. And I think just if I was to make a critique of the model, it's not to anything that you've presented here, but perhaps some things that are not contained within the math that you've modeled. And when I look at the broader investment environment today, and I see gold put on 4.5 trillion in market cap in the space of a few months.
100%.
And I just wonder whether or not we are entering a new epoch in the investment landscape that there is. And, we spoke earlier about the power of memes in forming narratives, and narratives certainly affect our realities. We're increasingly seeing very well-credentialed, highly reputable investment professionals put Bitcoin and gold in the same bucket as part of the same monetary debasement trade, inflation hedge. And so, that's not us memeing on the timeline anymore. We're seeing that pushed into the mainstream narrative by, Wall Street professionals, legendary hedge fund managers, Larry Fink, right? Like, where are we? we were joking about this stuff 4 or 5 years ago, and now it's happening.
Now it's here. It's here, and it's kind of like you kind of sometimes forget that we're essentially. That's why I said earlier we crossed the chasm, because I do think we completely have. At this point, the discount of Bitcoin going to zero. That's another thing that's worth mentioning. I don't think we're going to have these 80, 90% pullbacks anymore in Bitcoin, because in those past cycles when we had those pullbacks, there was a discount of Bitcoin could go to zero. I don't think we have that same discount anymore. People will understand there's going to be pullbacks, but I don't think people think at this point, the majority of people are saying the probability of Bitcoin going to zero at this point is so low that we can almost disregard it. And that wasn't the case just 3-5 years ago even.
No, I mean, I've had people tell me with confidence that nation states are mining Bitcoin, nation states are buying Bitcoin. They're just undeclared right now. And 100%. We're not talking minnows either. So, I give gold as the example because people keep saying Bitcoin is a 2 trillion market cap asset now. Where's the money going to come from to push it higher? And I'm like, gold's just so added 4.5 trillion like it was nothing. And I know it started from a bigger base. But let's face it, last cycle, gold was a $10 trillion market cap. Yep. It's now in, what is it, 27, 20, something like that? 23, 24, 25 trillion.
It's
right?
It's getting
it's
up
added
there,
5x the market cap of Bitcoin's current market cap. And it did that in a space of 3 years. Yep. And 4.5 trillion of that, which is double Bitcoin's current market cap, in just a few months. There is a lot of money out there. What they need is to be convinced of the narrative that Bitcoin is an investable asset and it's part of the same monetary debasement trade. And then once they accept that, then they have a look at all the features and then the virtues. and then they become convinced of Bitcoin being not just part of the same trade, but a superior asset.
Yeah, I mean, I completely agree. Like parity with gold seems inevitable at some point. It's a moving target right now as gold keeps expanding its market cap. But I do think, that idea that Bitcoin.
Sorry to interrupt you. I just want to go through this exercise. Is like, okay, if we say that it's inevitable that Bitcoin will reach gold parity, right? Can you just quickly look up what's gold's market cap? Is it, for the sake of argument, let's just say it's 23 trillion. It makes it easier. We can just say, okay, Bitcoin needs to 10x to reach that, right? If Bitcoin needs to 10x to reach that, and your model says in 5 years it has a 1% chance of being $769,000. So we're saying that it's going to take at least 7, 8, 9 years to
not
reach
a 1% chance. I would say it doesn't have a 1% chance of getting to 7. It's a little bit. It's spent 1% of the time at that extended.
Okay, I beg your pardon.
Equivalent. You could say it spent 1% of the days there. So on any given day, it's got a 1% chance to be there. But the odds of it going there is not 1%, but it's 1% on any given day.
I got you. Okay, my apologies. I misrepresented what you're saying. But it's a small chance, right? It's a vanishing. It's quite a small chance. So we're looking at like 7 or 8 years. Maybe 10 years.
Well, you can look at the 50. If you look at the 50, there's a 50% chance on any given day. In 5 years from now, there's a 50% chance on any given day will be around this level, you could say.
Mm-hmm.
So 5 years from now, just like we're trading now kind of around just over 100,000, we should be kind of doing the same at around 500,000 in 5 years. It doesn't get us to parity with gold. I mean, Bitcoin has to be if gold, it depends on how much gold moves, but 1 million Bitcoin to 1.5 million Bitcoin, like 1.5 million to 1 million Bitcoin is probably going to be that gold parity. It'll end up being probably 1.5 to 2 by the time we get there. But yeah, Bitcoin's got to get well over $1 million to reach gold parity. There's no question about that. So how long will that take? That's the question, right? So yeah, I mean, we'll see. I would love this model to break. Of course, if it breaks the upside, that would be amazing. I do think, going back to the nation states and the mining, I do think in the end, the majority of Bitcoin will be mined by nation states. I think corporations will mine. Maybe there'll be a couple big winners corporation-wise. And I do actually think the big corporations that are mining Bitcoin will end up becoming part of the government mining Bitcoin. I think it'll all be under the same arm. Like, I wouldn't be surprised if those big corporations that are partnering with the government in every country to mine. So it'll be more of a nation-state mining operation for all the major countries. Combination of the biggest corporations and the government itself. So yeah, that would be pretty insane to see. You're looking at at that point, all the countries kind of have to be bought in if they're mining and involved in funding mining through these corporations or subsidizing or whatever they do, subsidize power, whatever they do. So yeah, we're not far off. I mean, it could be within the next 5 years. That's just par for the course, right? Like all these nation states are mining Bitcoin, and they're public about it, and they're funding it directly from printing dollars, right? Like, I mean, it's kind of inevitable that big nation states are going to be printing money, adding more money supply to fund Bitcoin mining, and that's further going to cement and stabilize the network. And then the settlement layer then becomes a no-brainer. I mean, you have decentralization, so it seems like we're on the right path, at least to become parity with gold. So this is the thing. I think it's important for people to understand their biases. So some people are more pessimistic by nature, and some people are more optimistic, and that's not a judgment on personality types, but it's important to understand your personality types and your kind of biases. So I identified last cycle that I'm naturally optimistic. That's my personality type. So for me, it's actually easier to buy when the price is down, but it's harder to sell when the price is up. And if someone's the opposite, they're more of a pessimistic personality, they tend to see more the negative. They have a hard time buying when the price is low, but they can sell when the price moves up. So if you understand that about yourself and your bias, you kind of have to look for reasons to be less bullish in a way, because my bias is actually to be more bullish. I'm similar to you. I'm actually a very optimistic person. I tend to think the best things are going to happen in the future. And I tend to be a bit more biased in that nature to look for the positive more than the less positive news. And so I don't know, it's just my ideas. It's good to kind of like balance that out a bit. And
I'm actually a lot worse because I think the good is going to start accelerating. So I'm not just optimistic.
Right.
I just think it's going to
exponential. You're an exponential bull. Exponential
well,
bull.
like I said, I'm a bulltard. I wasn't exaggerating. I really am a bulltard. Yeah.
Well, it's hard, but the thing that makes sense though, given who you are. I mean, you're somebody who's constantly posting about the latest Bitcoin news. Like, how can you not be bullish? You're somebody who's on top of what's going on in the space. You've been posting consistently for years. Like you spend your whole day. I mean, I would assume you spend a lot of your time being aware of everything that's going on with Bitcoin. So I can see why you're so bullish, right?
I wish I could put it down to that, but I think my retardation predates Bitcoin.
Oh, okay. Well, I'm trying to give you an out there, but
no need for excuses or alibis. It's just who I am. It's just the way I am.
But how do you find that then? How do you find like do you tend to be disappointed? Like because when you're in that perpetual optimistic state, right? Yeah. Being in a perpetual optimistic state is great in the way that you have energy, you feel motivated, you're like, okay, let's go. Things are always going to get better. They're going to get exponentially better. But when you kind of don't live up to that sometimes, like how do you kind of deal with that? I guess, does your optimism just take you through those periods as well? Or how do you kind of balance that?
That's a really good question. So like I'm afflicted with probably the worst disposition of all to manage risk, because not only am I a very optimistic person, but I'm a high conviction person and I fall in love with my ideas, which inevitably means that I think I'm always right. But I've learned through some very harsh life lessons and some losses that how to temper that. So, I've eaten my own cooking and I've suffered well enough to be more cautious about my own disposition and first of all, to recognize how I'm built and how I am, why that is, and harness that in a good way without it jeopardizing my good work, which, I'm also prone to self-sabotage as well. But on the flip side, I'm really good in the crisis. So, nothing really phases me when things go bad. The bear market didn't phase me. And I don't tend to get euphoric in the good times. Like I'm just, okay, that's great.
You kind of expect it. When it's happening, you're kind of like, I thought this would happen.
Yeah.
It's not like people that get extremely euphoric are probably the people that, maybe they didn't expect it or they're kind of surprised or they don't have that same level of conviction. When your conviction is that high, when it happens, you're like, it's expected. I'm in a similar boat. I would say like my conviction with Bitcoin is so high from looking into the data on it mainly that I'm not surprised. I kind of I have high expectations for Bitcoin, and when it lives up to them, it's like, okay, it's just another day. That's interesting. Yeah, I guess.
Also, what I found out in the last bear market is my self-confidence doesn't fluctuate with my self-worth at all.
That's good. That's
like
a good
social
thing.
status
That's
doesn't.
Really good
thing. Social status doesn't do that either. So, like I've been in situations where I've been really low, and I'm, I've been surprised at my resilient self-confidence in those circumstances too. It doesn't mean that people don't judge me in it, and I don't notice it, but it doesn't affect my self-worth. So, like money, I was pleasantly surprised that when my net worth was at its peak in the last bull market, it didn't really bother me or didn't change me as a person at all. I was still pretty much the same person. And then when it plummeted 75%, virtually nothing changed. It's the same coffee I look forward to every single day, and that makes my day, and all the usual things. So
that's important. Like I think Bitcoin almost forces people to a degree, at least to whatever extent their personality will allow, for them to kind of go more in that direction of not attaching their value to these numbers on a screen, because these numbers fluctuate so much and it's a long-term investment, a long-term trade. And if you're looking at, like, I'd never look at the cumulative, the number that's my Bitcoin in US dollars or what, I never look at that number ever, like literally never, because I know it's a dangerous number to look at, because once you see that number, you start to think, you don't want to get attached to that number because of the fluctuation of volatility. And you want to be focused more on just the long-term patterns and have conviction, because that increases the emotions when you start to get attached to those numbers on a screen, and those emotions cause us to potentially make bad decisions. So I really do try to ignore, and and to be completely honest, my obsession with looking at Bitcoin data, it is a way of distracting myself during those times. I tend to not follow too much kind of mainstream news or these headlines as much. The FUD or whatever you call it, I tend to not get sucked into that stuff because I'm just not focused on it by intention. Intentionally, I'm not.
Well, we've come full circle, really. We've come full circle to the whole idea of having patient money, right? So you've got an intellectual pursuit with your analysis of Bitcoin, and that's why I encourage most other people, like, get a job, because first of all, that's going to allow you to have patient money in Bitcoin such that you're not obsessed over it and you're not stressing out when it's high and, spending your waking hours speculating about whether or not you should cash out now or cash out later. What if you miss out? What if you don't? All of these things, they're just detrimental to your life, because you could be spending that time and energy, which, you have no effect on the Bitcoin price. You could spend that time and energy more productively on improving yourself, working better and harder at your job, maybe getting a better job, maybe starting a business, doing something that gives you greater independence and satisfaction, rather than just looking at the Bitcoin price. I'm very fortunate that my business is Bitcoin now. And so, I get to focus on building a business, which takes me away from, any kind of inclination to speculate on whether or not I should take a little bit off now, a little bit off later, for my lifestyle and the like. I don't need to do that anymore, so I'm really grateful for that. But, if you've got a job, working is an honorable thing to do. Don't fall for these online memesters who flex with their rented Ferraris and Lamborghinis. Working is an honorable thing to do. You get a lot of self-worth, and it's a good way to spend your time away from the anxiety of charts.
100%. I think it's well said, and I think it's important. Yeah, we're designed by nature. I think it's in our DNA to do something productive, whatever that is. Going and chopping wood, like something like, and there's also like working on a screen. Definitely, you're still building stuff, and that's also obviously, it's contribution when you're building content. It's nice, getting feedback on that content. So there's definitely something there that's very strong. But I think people are also programmed to do stuff in the physical world. Like when I say do stuff, I mean, like actually doing work. And that's where a lot of people go to the gym, right? So I think like this cycle, last cycle, I wasn't really going to the gym as much. This cycle, especially the last 3 months, I've been going like almost every day, and it helps. It's so beneficial, man.
You have to go to the gym.
If you don't have a physical job, if you don't have a physical job, it's almost the only way to balance. You have to take up some sport pretty significantly, or go to the gym or something. At least in my opinion, like that is so important to balance the stability of emotions and things like this. And
it stabilizes you emotionally, 100%. Yeah, it boosts your testosterone. It gets rid of any excess energy. You feel better. You develop a higher level threshold to deal with your stresses during the day. I'm fortunate that I just fell into the right habits from a very early age. But there were moments when I wasn't able to work out, and I felt it. I really did feel the difference.
Yeah, 100%.
Was there anything else you want to show us about with the Quantile model? Because that was really instructive. I like that. I was gonna say, how's that different from the rainbow model, bro?
Good question. Good question. Very different, actually. So they look similar. That's the thing. That's definitely, aesthetically. Actually, the gray band on the bottom and the gray band on the top was a specific choice because I wanted to not look like the rainbow model. So I actually haven't looked into the rainbow models too heavily as far as how they're actually constructed. But it's very clear to see, if you just, for at least most of them I've come across, is you're kind of going to a lower band every single cycle. I don't know. I don't know exactly how they're creating them, but they're definitely not the same.
Well, the guy who created it, I think his name's Eric something or other, Eric Wall or something. He's one of Udi's friends. He literally said, I pulled this out of my ass. And now actually people refer to it in some kind of semi-serious way. I mean, it looks really nice and it feels like it feels like it's holding true to the rainbow model, right?
Well,
But,
it definitely might be directionally. I mean, it probably will be directionally correct because he basically just identified that, because we spent so much time looking at Bitcoin in log linear space. A lot of the charts are log linear. Because if you're zooming out, like a lot of people that do TA, of course, are looking at Bitcoin and linear on X and Y axis. But when you zoom out, because of how much growth Bitcoin has had since the beginning, you have to pretty much look at it in log linear, log on the Y axis, right? On the vertical. So at least people are looking at Bitcoin in log linear. And when you do that, you do see that kind of pattern, right? It makes sense that people will, connect dots and do these rainbow type charts. The difference with the Quantile model is it's actually looking at Bitcoin in log, and then it's displaying it log linear. So it is a very different thing than the rainbow model. And I'm not sure specifically, I would be very surprised it's different when you look at them side by side. But the decay function that we talked about and the power law in the Quantile kind of framework is really what sets the Quantile model, in my opinion. And I've looked at all the other models out there. I really have. I'm not just saying that. I mean, there's good models for sure, and there's good ideas, no question. There's a lot of great analysts in the space, no question.
I'm hoping to speak to Giovanni.
Giovanni,
Yeah.
definitely an interesting interview. At one point I had a 9-hour phone call with Giovanni.
Oh yeah.
So when we were getting along, we don't get along as well these days, but yeah, he's an interesting personality, but he's a very smart guy. And Sminston's another guy you should definitely have on. He's created a Bitcoin retirement guide that is really awesome. He's based it around the power law, and seen as another great analyst. So I've spent hours talking to all these guys. It's a pretty relatively small community, but a lot of very smart minds. So, but yeah, nothing else to add, and really just appreciate you having me on and give me the platform and the conversation. It's been a pleasure to chat, and
It's my pleasure to host you for a chat, man. You came to my attention, in the last cycle, and when I was posting really quite heavily, and I enjoyed your analysis that you were posting, and you came pretty close to the sun at one point. You know what I'm talking about, but I was grateful. I was very happy to see you pull away from that towards the end, and you were okay.
Oh yeah, that was a crazy. That's a whole nother conversation.
Yeah,
but that was a really good lesson, and I was fortunate that I was able to get all my Bitcoin off in time, and it all panned out. I definitely took some lumps from that, and that was one of the things. I mean, probably a lot of people can relate, but that was humbling last cycle because I learned the lesson of. It's tricky. I tend to be hard on myself with this specific topic. But at the same time, if I look back, nobody knew what was going on with Celsius. I mean, there was the CEO went to jail for 10 years. I mean, it was a black box. Everything he said on streams was a complete lie. So there was just complete misrepresentation of what it was. And one of the things that happened was when you hold an altcoin, because I held Celsius at the time, it was the best performing coin in 2020. It did a 200, or I think it was a 300x. So Celsius went up so fast, so quickly in 2020 that I just had the insane, greed goggles, whatever you want to call it. On paper, again, that lesson of seeing your net worth going well above anything you could have ever imagined. It's almost a cult. You combine like a cult with money, and it's dangerous.
And he actively cultivated that. He was a bit of a smooth talking, charming sort of guy to people who were, let's say, predisposed to trust. You seem like a really decent guy, really trusting guy, and you took him for his word, and he turned out to be a con man.
That's actually one of the things that I would say I learned the lesson of not being too naive and trustworthy, because I actually do. Yeah, I would say that is a characteristic, is to kind of be over trusting, and so that was a tough lesson to go through. But at the same time, it made me more better to assess red flags, because if I look back, those red flags were everywhere. But it's because he did a weekly stream, and because they built this whole thing around the community, and your identity gets attached to being one of the influencers in this community. I mean, a lot of people can probably relate with altcoins, but it's nice that Bitcoin doesn't have. It's one of the best things about just holding Bitcoin is there's no there's a community, but there's none of this like politics or there's none of this it's different than a CEO, right? Humans making weird decisions and lying, and you don't have to worry about any of that nonsense. So that's
Bitcoin is filled with the sort of characters that make you not want to be part of the community, to be honest. Sometimes it's like, what am I doing here? Why am I putting up with this shit? But overall it's very well worth it. My life has certainly been enriched by the community. That's for sure.
Yeah, 100%. Well, thanks again. Thanks for having me on, and we'll have to do it again at some point. Maybe we'll see. Maybe when we're actually in that top quantile or close to it, we'll have to reassess things and see where we're at.
I'd love to, man. You're welcome back anytime.
Awesome. All right.
Thanks, Plan C. Appreciate it.
Take care.
Cheers.
Have a good day.